From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those championing market growth and anchoring the nation's economy, small businesses, and entrepreneurs.
Hey, everyone. Welcome to another episode of the Simple Numbers Profitability Playbook Podcast. I'm Mike Maxson. That's Brandon Gray, and happy Monday.
Hey, we're here.
You have a good weekend?
Yeah, it was a busy weekend. So we moved into a new house last year, and I have finally gotten my lawn put in. So in the South, it's a yard.
Ooh.
For everyone else, it's a lawn. So
That's right.
I spent hours on tractors moving dirt and Harley raking, and got the sod laid, and then rented a roller and went over the yard with the roller. And then we had some folks over for a event with our football program. So, all those things that you need to do. And when you're going to have a house full of people, it pushes you to get them done.
Yep.
So I come out of the weekend feeling accomplished. Like, hey, I'm knocking stuff out.
Except it goes by in 5 minutes, right?
Oh, yeah. Yeah. It moves quick. How about you?
Yeah. Girls are down in Birmingham for a ECNL, just team camp for the weekend. So put it this way, everybody. I love being the adult now because they get to run around in the heat. And you're just like, man, it's hot out here. I'm going to the car. Sit in AC for a little bit, come back, and just support them through it. That's all I had to do. So make sure they had water. But all right, so we're gonna have an exciting podcast today, talking fixed assets.
There you go. About half the people just turned it off.
That's right. Yeah, we lost you. They're like, fixed assets. Oh, that thing on the balance sheet. No, there's more to it than that. And so we'll talk into that, and I'll let Brandon just kick us off here. First of all, what made you think of that one?
Well, I was looking back at some of the topics we had discussed, and this is one that we haven't covered.
You're right.
We talked a lot, everything from gross margin, labor efficiency, operating expenses, marketing, debt, capital, return on investment, which we're going to hit a little bit more in just a second. But I thought, this is something that a lot of businesses spend a ton of money on.
Oh, yeah.
I'm just interested about it. So, how do you approach it? What are some tips that we could pass on as we've seen folks make really large purchases and they turned out great? Other cases to where folks have made really large purchases and it didn't turn out very well. So what's the difference and kind of the way we should view it? So,
well, tell us first, just to make sure the audience knows, what exactly do you mean by it? What is a fixed asset?
Yeah, that's a great accounting term, right? So, it's one of those that typically whenever you start a business and you go buy stuff, you don't think of, I'm buying fixed assets until you go to get your tax return done. And everybody's like, well, this should be a fixed asset. And you're like, well, so basically think of it, of anything that has a life that is going to be for a multiple number of years. So it's not a material, it's not a supply, it's not a small tool. This is a substantial purchase, in most cases, several $1,000s. It's got, to use the accounting jargon, a useful life, right? Mm-hmm. Several years, usually 3, 5, 10, 15, could be 30, with a building or something like that. So it's something that you purchase today that you're going to use for quite some time. And so when you look at the accounting methodology behind it, it lives over on your balance sheet instead of your profit and loss statement. So, we'll just use like a service truck, for example. So you buy like a $70,000 service vehicle. We're going to get a nice one because we want the air conditioner and, the cooled seats and all that jazz. Right. So if I had profit this year of $100,000 and I just expense that $70,000 vehicle, now it looks like I have profit of 30. And you can do that in a lot of cases for tax purposes, but it really distorted your profit because you're going to use that truck for 5, 7, 10 years. So really the correct way to be looking at it is that I'm going to use it for 5 years, 1/5 or 20% of its cost each year. So I'm just expensing it over time. And so that asset lives over there. And then as I take a little bit of expense each year on it, comes over your P&L in form of depreciation. So there's a little bit of accounting jargon. That's what we mean.
I love accounting jargon. So we have fixed assets when you could say a building or a vehicle. Then you got to say capital when really you mean cash. And then accountants love the term, it's got to tie. tie here, tie there, tie this. It's like, oh, you mean balance? Oh yeah, that's it. Okay.
Make it easy. So as you think about those, most every business is going to need them. If you're strictly services, it might be as simple as computer equipment, desks and furniture, those kind of things. But a lot of folks,
valued over a certain amount, right, Brandon? Typically, it's just 2,000 IRS rules.
I mean, I think there's, I would be speaking out of turn if I started quoting IRS regs, but typically what companies have is what they refer to as a capitalization policy. So anything under a certain amount, you just go ahead and expense it. That's usually a few $1,000. So get with your CPA on all that. But as we're talking today, we're talking more significant, think of anything that you're going to spend 10, 20, 30, 40, $2 million on, not talking about the smaller things. So
IRS is saying $2,500 according to AI.
Okay.
Well, AI said it.
Yeah, I know. By the way, speaking of AI, complete aside here, but my mind took me there. So our Simple Numbers clients, a lot of them participated in a community model coaching call, which is part of one of the service offerings we have, where we just help educate people, spend an hour a month kind of going through different topics. Had Christian Hyatt from Risk360, cybersecurity firm, speak last week. And he went through some of the cybersecurity threats that AI has brought about. And one of the things he's talking about is AI's ability to change someone's appearance and their voice. And so you're doing an interview with someone who is a North Korean spy and you have no idea. And then you hire them.
Well, what's funny is that's why on the podcast before we had Mike Coffey on, his company's doing the biometrics at his background check company to help mitigate that. We're just trying, we're just name dropping all over the place.
Anyway, AI, all right, let's fix that then. Keep me focused, Mike.
Well, I'm just saying real quick, we could have deep fake Mike and Brandon hosting podcasts and we're just, but they'll have trouble matching me. They will.
Yeah, no doubt. So as we look at these purchases, I want you to think of them in two buckets. So the first bucket is just, it's required. You're a plumbing company and one of your vans is constantly in the shop. I can't make any money when that van's in the shop. I gotta go buy another vehicle, right? Or equipment breaks and I got to replace the equipment, or computers and servers need updated. It's just the normal, got to do it. It's not intended for growth of the business or expansion of the business or to change the return or efficiencies. It's just the normal course. I got to replace these assets as they wear out. And so, a lot of times we'll get questions, should I buy a new vehicle? Should I lease a vehicle? Should I try to find some used equipment? And, I don't know if there is a hard and fast rule around the best way to handle those replacements. My kind of thing is, I need to move with haste, especially if I'm unable to produce. So, you can go buy a new one, you can buy a used one, whatever works for you. We'll talk about financing here in a second, but it's kind of the things of, I can't spend 3 months shopping for it. Let's get it solved. The one I want to talk a little bit more about though is whenever we're buying assets that are an investment that we expect to get a return on in addition to what we're already doing. So think about, I've had clients in the past, they've got machinery and equipment, they're in maybe manufacturing, and a new piece of equipment comes out and it's either faster or automated or has a larger capacity. Could be a number of things, but it's more expensive than what you currently have, and what you have is looking fine. So do I upgrade to the latest and greatest, something that perhaps could gain me efficiencies, or do I keep what I have? In those cases, that's where you want to use that return on investment threshold that we discuss of 50%. Now, this doesn't mean 50% in 1 year, because I'm going to use this over the course of several years. So I'll give you an example. We've had clients purchase machinery that can be automated. So, I might have had 1, 2, 3 people working in this process. The system, the machine does it all. So, first thing is, does it really do it all? Because I think all of us have seen examples to where there's more sizzle than steak when it comes to those types of things. So you want to definitely do your homework. We'll speak a little bit more about that here in just a second whenever you're purchasing something new. Secondly, I start to look at, okay, well, what's it really going to do in terms of an increase in output and a decrease in labor spend? And I can start to use those factors to look at the return on investment. How quickly do I get my money back? When do I start producing a 50% return, so forth and so on. A lot of times the manufacturer will have studies performed that you can get around labor savings, cost savings, efficiencies, those kind of things. That's a good starting point. But, I never run them based upon exactly what that manufacturer's saying. They're going to give you the best picture. I might run at 70% of what they're saying. Okay, now at 70%, what does that look like as far as that part goes? So you definitely want to use a filter, and it can be a great investment. Like I said, I've seen clients that they've been able to really reduce some labor costs, automate things, increase capacity, what have you. But once again, you want to make sure you get back to that 50% return. Mike, any thoughts on that?
No, it's pretty straightforward. I mean, that's usually where the biggest pitfall with clients come in, is when we have these fixed asset discussions. Is typically around, hey, I'm going to do this if I do this, I'm going to get more, right? Meaning revenue, sales, more profit. We can produce more. And that's usually where it is. It's like, are you sure? Have you looked at that? And then, does that, are you up against production right now? Because, and we had, Zach Oliva on here a few episodes ago, and he's one of those ones where they're growing so rapidly, the need to add space was paramount, because they got to hire more attorneys. And so need to expand, need to do it. And that would have been a direct correlation to, hey, you could tie it to, like, hey, we're growing so fast, we have a backlog. I need this many attorneys to do it. It will produce us X. It will then pay for what our expansion is. And so that was one of the easy ones. But there's sometimes where it's like things are going good, and it's like, well, hey, I need a new building, or I need to expand it. It's like, well, does that actually increase production and gonna get us that return? And that's usually where these discussions really go with it, is that right there.
Yeah, Debo. Two things on those lines. One, as you decide to move forward with the investment, make sure we're tracking. Let's track and see, what did we really invest? What did we spend? What was the labor hours, and looking at what it was before? Or the labor costs, not hours, before. And so you kind of can do an apples to apples. Secondly, on the facility one. So if I can, I'd like to quote the great Greg Crabtree. Don't fall in love with a facility, because a facility or a building will not love you back. And I can't tell you the number of times I've seen folks that have found the office space downtown, newly renovated building, really convenient, great. Everything's going to be perfect, right? And they kind of get trapped. They're in more space than they need. It's more expensive than what they should be paying. And yeah, it sounds cool and it looks cool. And we kind of sometimes, I wouldn't say lie to ourselves, but we justify it by going, well, clients or people will really enjoy coming to this building, and it's going to give me a little bit more exposure. Well, it may, but I would say, generally speaking, that's a pretty mild list.
I would love to know how many people, unless you are a straight retail storefront, like, get the amount of foot traffic that justifies some of that stuff. Like, I'm sorry, but if someone's not shopping for a product in your store, I'm just, even us over the years, we've talked about it with us. Like, once our foot traffic has dwindled drastically from the moment I started at Crabtree Row and Burger versus where we are right now. I mean, I might see one person from the outside coming here a week, outside of a delivery person dropping stuff off.
And don't get me wrong. I mean, I think we have a nice space. It's good. Nothing super elaborate, but I mean, you want a safe area. You want a place, especially if your team's going to be there a lot. You want capacity if you've got mixed use, where I need, I got warehouse or production space, and then I've got offices. All those are great things, but you got to kind of keep in mind what margin am I going to have to produce to cover this additional facility costs, and is it worth it?
The next thing I run into is the fleet vehicles for companies that are running crews. And so whether it's tree care, landscape, irrigation, anything like that, where they're running crews, hey, I need a 2 new truck, I'm going to spin up the crew. Well, a lot of times they're only thinking about the crew ROI, and they're not thinking about the vehicle and the equipment associated with servicing that.
Yeah.
So it's like, yeah, remember when we're calculating this, we also got a fixed asset over here we got to account for.
Exactly.
And that was 2 or 3 new trucks that we just added with these crews. And, while, yes, we look at it, labor efficiency and what have you, we can get this out of the crews if we sell to this. But, oh, by the way, we just spent $300,000 in trucks, so.
Yeah, those trucks are going to come with fuel, insurance, repairs, and maintenance. It's going to be expensive. So like Mike said, factor all that cost in. If I did not have this activity, would that cost go away? And if it does, then you kind of can allocate it to it. So just want to be smart. And once again, shoot you at that 50% return. So then the questions start to become then, okay, well, I have identified let me back up. I forgot about one thing. If you are buying specialized or customized equipment or machinery, if it's something that is new and innovative, or there's very few of them being produced, I am yet to have a client who made that purchase, had it installed, and from day one it worked properly. That's what I've had clients purchase custom machinery, and guess what? It works for 8 hours, and then something goes down on it. You've got to try to get the engineering team from the manufacturer to come out and troubleshoot it and repair it. And yeah, it may be covered under a warranty, but the downtime that you experienced is substantial. I had another client just purchase some in April, May timeframe. Two new machines that are revenue producing machines and margin producing machines. They worked for a week, and both of them were down for like 4 weeks after. So as you're playing all of this, keep in mind it's probably not going to work right out of the box like you want it to. So just know. All right. So then, do I finance it or do I pay cash? Yeah, that's like that. A lot of folks ask that question. So I'll kind of, I'm a caution of giving Dave Ramsey advice here, which is blanket advice that may not be applicable to every situation. I'm going to give a little blanket advice. So typically speaking, we want the cash outlay for that equipment to match the life of that equipment. Okay, so I'm typically going to finance it. So if this is going to last me 5 years, then I might have to pay a little bit down, but the remainder I want to pay over 5 years. That way, as I have the cash inflow coming in from it, I got the cash outflow to pay for it, and the two match. All right. In some cases, that's a little more difficult. The thing to be cautious of, especially if it's something beyond, vehicles and normal machine or equipment and machinery, that you can get that financed in most cases. It's not a big issue. But if it's something more specialized or more unique, a lot of times what we see happen is it's got a 10-year life. You got to pay 20% down on it, and the financing company or the bank wants to finance it over 5 years. Well, that's a good way to put yourself in a cash flow corner, because I'm paying for something that's going to last me 10 years, has a 10-year price tag, but I'm only able to get a 5-year note on it. Well, the first 5 years are probably going to be pretty tough in a lot of cases. The next 5, if it lasts, yeah, sure, that's great. But a lot of times what we see is you get through that first 5 and you're growing, you add the next one. So do your best to try to get the financing term over the true useful life of the asset. I might be a year or two quick on that. If it's supposed to be 10 years, I might go 8 or 9, but I'm definitely not going to go 5 because I want to avoid getting upside down in that piece of equipment. So keep that part in mind. The other question we get is, do you lease or do you buy? Once again, blanket advice here. Most of the time we've ran an analysis on that for like service vehicles and fleets. There's typically not a big difference. And once again, I'm talking about business use. I'm not talking about your personal vehicle. It's a separate topic. But, with a lot of the leasing programs, it's covering all the maintenance, all the repairs. If you're out of vehicle, they give you a replacement, all that kind of jazz. You kind of look at the cost of that, then you do the analysis of what would I purchase it at, what would my repairs and maintenance be, minus what I could sell it for at the end. They usually come out to be fairly close. And for me, the biggest thing is I've got to have this asset to produce margin dollars. So the last thing I need is for that asset to be a shop off line. So it's a little bit of a couple thoughts along those lines. We'll probably get plenty of emails and calls and what have you, and folks disagreeing there. But once again, it's just general advice. You want to look at each situation and make sure that's the case. But generally, I haven't seen a big difference between the two routes.
Mm-hmm. Yeah, I mean that's really another thing that we get is newer used with a lot of the equipment, the likes of the trucks too. Like I'm going to go add to the fleet, buy trucks and things like that. And I usually say the same thing to them as going, hey, if I'm going to get this used, but it's going to be down, if it's not going to, because a lot of these people are running hot, and they're usually buying the vehicles like, hey, I'm about to spin up a crew. Is this something that, we want to get more solid years out of? I mean, that's what you're going to have to weigh in interest rates and when you're going to, you get the better deal on the newer versus the used or vice versa.
And what's in the market? You might come across 3 or 4 used vans with low mileage on it. It's a great buy and it works out perfectly, but I think that's an anomaly. Now, I would say on heavy equipment, excavators, backhoes, bulldozers, all those fun toys. Right now, we're seeing a little bit of a shift there to where there's some decent used equipment out there. Folks that maybe got in a little bit over their head, and as the marketplace has changed, they're consuming assets and selling things off for cash flow. You can find some deals there, but once again, you just got to kind of know what you're getting into and be familiar with that marketplace.
Well, awesome.
Good deal. Well, maybe we made assets somewhat interesting,
Yeah.
I mean, you're going to spend hundreds of thousands, maybe millions of dollars on these. We should at least on it and look at it. Questions or thoughts on it, let us know. Before we close out, I want to remind everyone of the Simple Start program. So we've mentioned this on a couple podcasts already. We've got folks entering. So if you want to be part of the contest or receive the Simple Start program free of charge, here's what you got to do. Go to the Simple Numbers LinkedIn page and just simply message Simple Start. That's all you got to do. It's going to be an hour to hour and a half call. We're going to look at some financials. We're going to look at labor efficiency. We're going to talk about profitability, give you a quick, real simple start to, kind of here's where you are, maybe a few things that you need to do to move forward. Giving that away free of charge. So, but the key to win it is you've got to go to the Simple Numbers LinkedIn page, message us Simple Start. Got just a couple weeks left to enter. So go ahead and do that.
Awesome. Well, very cool. We will catch everyone next week. I have no idea what we're going to be talking about then, but we will think of something. We hope it's more entertaining than fixed assets. Me and Brandon, one of these days, we're just going to go wild. We're going to come on here. You all are going to turn it on, and we're going to be talking about God only knows what. But I promise it won't get us fired. I've been mindful of that. But anyways, you all have a great week, and we will we'll see you, actually in a week. So for Brandon, I'm Mike. You all have a good one.
See you guys.
If you want to know more about driving sustainable profitability for your business or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Spotify, Apple Podcasts, or wherever you prefer to listen to podcasts. If you like what you heard today, please leave us a review. This podcast is brought to you by CRI Simple Numbers LLC, a division of CRI Capital Group LLC, and a subsidiary of CRI Advisors LLC. CRI is the trusted brand under which Carr, Riggs & Ingram LLC, the CPA firm, and CRI Advisors LLC, along with its subsidiaries, deliver professional services. Please note, Carr, Riggs & Ingram LLC is a licensed independent CPA firm offering attest services, whereas CRI Advisors LLC and its subsidiaries specialize in providing tax and business consulting services. These entities operate within an alternative practice structure as defined by the AICPA Code of Professional Conduct and comply fully with applicable laws, regulations, and professional standards. Ready to simplify your business finances and drive growth? Explore valuable resources, books, and tools designed for entrepreneurs and small businesses at simplenumberscri.com.